So, yesterday in the stock market, the financials and private equity sectors sold off dramatically. And many of you have been asking me what is going on here and why are these stocks selling off so much. For example, Apollo was down 8.6%, KKR down 6.6%, Bank of America down 5%, JP Morgan was down 3% at one point, Brookfield Corporation was down 3.5%, and even Brookfield Asset Management was down 4% yesterday. Now, this sell off is happening because it's been reported that there has been some weakness in specific private equity investment books, and now investors and the market as a whole is starting to worry that this is an early sign of contagion, or in other words, that losses in these private equity books could start skyrocketing. For example, an analyst at UBS is now saying that private equity defaults could hit 15%, which is higher than during the financial crisis. So in this video, I want to share all of the news that has been happening in the financials and private equity sectors that has been causing this sell-off on Friday. Then we will also be listening to an interview from Bruce Flatt where he was asked directly about this sell-off and the worries that investors are having. He's a very grounded person, and I think that he shares a very useful perspective right now. So with all that being said, let's just hop right into the video. So the first major piece of news that I think is impacting the sector most is what is going on with a private equity firm called Blue Owl. And this article right here says Blue Owl turmoil adds to strain in $2 trillion US private credit sector. So what's been going on with Blue Owl is that late in 2025 and in early 2026, redemption requests from retail investors far beyond the company's historical norms. And this is because in November of 2025, Blue Owl tried to merge one of its private funds into one of its publicly traded funds. However, investors realized that the public fund was trading at a 20% discount to its actual value, which meant that the investors would take a massive haircut on their money if the merger between the two funds actually went through. This triggered a bank run mentality, as investors rushed to pull out their cash at full net asset value before the merger could force them into the discounted public shares. Now, the private equity fund that Blue Owl had was a semi-liquid fund, which usually allows investors to withdraw up to 5% of the fund's value per quarter. But when 15 to 20% of investors all ask for their money back at once, then the manager has a choice: sell off some of its loan assets at a loss to raise the cash, or limit the amount of withdrawals that can happen. And Blue Owl chose to limit redemptions to protect the investors staying within the fund. Now, what Blue Owl is doing is they announced that they're selling $1.4 billion worth of direct lending investments to a group of pension and insurance companies. The management of the company is arguing that this is a win because the assets are being sold at 99.7% of the value that they have on the balance sheet, which basically means that they're selling for full value. And management is arguing that this shows that the company's assets on the balance sheet and their investments are actually still strong, and they're not being written down, and they're not actually losing a lot of money on their investments. However, the skeptics are saying that this is an emergency move to raise cash to pay off debt and give investors back their money. So ultimately what happened here with Blue Owl is they had a private fund and a public fund, and they tried to merge the private fund into the public fund. But investors noticed that the public fund was trading at a 20% discount to the net asset value of the fund. So by Blue Owl trying to merge these two funds together, the private investors realized that they would essentially lose 20% of their investment because the public fund was trading at such a discount to net asset value. So what the investors did is they started trying to withdraw or redeem their money within the private fund to get it out before the merger happened. And that is what caused this bank run in the private fund and what caused Blue Owl to start limiting the amount of redemptions that could happen in the fund because the redemptions were way above the quarterly limits. In my opinion, this is Blue Owl's management being kind of dumb rather than contagion spreading across the private equity market, because even the assets that Blue Owl is selling are still at 99.7% of par value, which means that they're not writing down these assets. But the market is still getting worried about Blue Owl limiting redemptions regardless, because this is the type of thing that was happening back in 2008 and in 2009 when investment funds and private equity firms were limiting the amount of money that investors could pull out because they were sitting on massive losses in those funds. So the market is connecting what Blue Owl is doing today to what happened back in 2008 and 2009 and saying that this is a canary in the coal mine and that things are going to start getting a lot worse for private equity And this is what ultimately caused all of the selling. This is what started all of it. However, there has been some more news coming out that's showing weakness in the private equity space. This article right here says FS KKR Capital Corp cut its dividend to 48 cents a share from 70 cents and said about 3.4% of its portfolio was on non-accrual at year end, meaning it no longer expects to collect interest on those investments. New Mountain Finance Corp also disclosed that it agreed to sell $477 million worth of assets at 94% of fair value as of December 31st. Another private credit fund overseen by Apollo cut its dividend and marked down the value of its assets amid signs of strain in parts of its loan book. Midcap Financial Investment Corp also lowered its quarterly payout to 31 cents a share from 38 cents per share and wrote down its portfolio by 3%. So an Apollo fund also marked down some of its assets, and Midcap Financial lowered its dividend payout as well and also wrote down its portfolio. So the carrying value of assets within these funds are going down, and now the market is that things could get a lot worse. Jamie Dimon also recently said that money managers are doing dumb things with risky lending, which parallels what he saw in 2008, which obviously is not helping sentiment across the financial sector. Other analysts are worried about the amount of software loans that are sitting on private equity balance sheets, given how scared everyone is of software right now. Some private equity funds also bought out software companies in 2021 and in 2022 when they were at record multiples. So now there's questions about losses on those investments and how investors will get their money back. However, Ares CEO said that the loans are still fine and that performance of the loans and businesses are stable. He also said that software companies are growing faster, are larger, and better capitalized than ever before. But the narrative around software as a whole is now impacting private equity, and especially the firms that have invested in software more than others. I find all of this very interesting because there's so much fears around the software sector that it's now spreading into the private equity sector, and specifically the businesses that have software loans and software investments. It seems like the market is trying to say that software companies are completely uninvestable, their loans are going to go bad, and even if you have any software exposure, it's a red flag. But if you go and take a look at the reports of software companies that have reported now, their fourth quarter reports, they're all quite strong. Revenues and cash flows are at all-time highs, and they're not in any financial stress. So if software is truly going to get disrupted and these loans are all going to go badly, then it's not really showing up in the financial data that the actual software companies are reporting, which is what the Ares CEO was trying to tell the market. But the sentiment is just so bad in the software space today. So in my opinion, the fears around software loans on private equity balance sheets is very overblown right now. This is a risk that hasn't materialized yet, and we're not really certain it ever will, because all these companies, again, are still growing and they're producing a record amount of cash flows. The risk that seems more real and more concerning to me is that funds managed by Apollo and KKR are writing down their assets by about 6% and lowering their dividend payouts. They're also saying that they're actually not expecting to receive their investment income from some of their investments now, which does suggest that those investments could be going bad. So those two companies seem like they may have made some not so good investments over the past few years that are now starting to lose value. And I also think that's why KKR and Apollo have been underperforming by quite a bit. So it seems like there is overall fear spreading in the private equity and financial space. But when it relates to Brookfield, I don't actually think that any of this news is impacting the fundamentals of Brookfield Asset Management and really that whole family of stocks. And this is because Brookfield doesn't invest in software companies or own software loans. They own, invest, and operate the backbone of the global economy, like data centers, railroads, pipelines, utilities, telecom towers, etc. The things that the world actually needs to continue growing and operating. That's what Brookfield's entire investment thesis really is. And that is also why I chose to have Brookfield in my portfolio and why I don't own Apollo or KKR. Those two businesses seem like they are a little bit more of a black box and kind of more in things that I don't quite understand. But Brookfield's entire investment philosophy and what they own and invest in, again, is the assets that are absolutely critical to the global economy. So those assets, I think, aren't really going to go bad anytime soon and only get more and more valuable over time. In Brookfield's 2025 annual report, they also wrote that during the year, they advanced a record $91 billion worth of asset sales across the business. And that monetization activity included $24 billion in real estate sales, $22 billion in infrastructure sales, $12 billion in renewable power, and $33 billion of other diversified assets across our operating businesses. Substantially all sales were completed at or above carrying values, returning significant value to their clients. Now, why this is important is because Brookfield is saying that they're still able to sell a record amount of assets, so there's still a large demand for the assets that Brookfield owns and invests in. And second, they're saying that their asset sales happened at or above the carrying values on the balance sheet, which suggests that their assets are still very valuable, and if anything, they're actually underreported on the balance sheet. And this is something that I track with Brookfield Corporation over the long term. And in every single earnings report, they give an update on how their asset sales are doing, if they're being sold at carrying value or above carrying value. And so far in my years owning Brookfield, it's always been at or above carrying value on the balance sheet. So again, I think that this suggests that their portfolio is still holding up, their investments are holding up, and there is still a large amount of demand for the assets that Brookfield owns. This next screenshot comes from Brookfield Corporation's 2025 letter to shareholders. And here Bruce Flatt wrote, "We had a record year with $112 billion of fundraising, $91 billion of assets sold, and approximately $175 billion of assets financed. This enabled us to acquire $126 billion worth of new investments." So in the shareholder letter, Bruce Flatt is writing that Brookfield all around had a record year for fundraising, for deploying capital, and for financing new investments. So it seems like this business is firing on all cylinders. And I made a full video on my channel for Brookfield Corporation and Brookfield Asset Management's fourth quarter earnings results. And it's very clear that these businesses are seeing a large amount of accelerations to their businesses. So in my view, not all private equity firms or asset managers are the same. It really depends on the assets that they're investing in and the management. It really comes down to the management and how good they are at actually investing, deploying capital, and protecting investor capital as well. And I think that Brookfield is just the all-star here. And again, that is why they are the stock in my portfolio and why I don't own Apollo or KKR. Brookfield weathered the storm of the financial crisis like an absolute pro. I would strongly recommend reading their investor letters and their shareholder letters from 2008 because it's a masterclass on fundamental value investing. And if you take a look, the business has performed incredibly well since then. They've also been investing in the backbone of the global economy for over 40 years. And they've been operating assets like utilities over that duration as well. So I think that they are master owners, operators, and investors. And they also have that long track record of protecting and growing shareholder capital. And I believe that they will continue to do so. So while there is this fear in the overall private equity and asset management space, I do think that Brookfield stock will get hit and continue to get hit if that fear continues to grow. But this is indiscriminate selling like we saw in the software sector recently. And when there is indiscriminate selling and people want to sell every stock across the entire sector because there's fear in that sector, I do think that creates opportunities to buy the highest quality businesses and the highest quality stocks in that sector at a discount. And I do believe that Brookfield Corporation and Brookfield Asset Management are now selling for discounts in the stock market, and their stocks are being hit unjustifiably. So with that being said, let's now hop into the Bruce Flatt interview and hear what the CEO of Brookfield has to say about all of the drama that's been happening in the financial space as well.
Now, the tech industry is increasingly fused with the world's biggest financial players. Nvidia, for example, has multiple business ties with Brookfield. The investment giant is racing to finance the power, hardware, and infrastructure that's driving the artificial intelligence boom. Now, the firm estimates that AI will require some $7 trillion in capital investment. But on the flip side, the tech revolution is also hitting the valuation of sectors like software, forcing private markets to reassess their exposure and deal making. So I'm excited to discuss the outlook for private equity and credit with Bruce Flatt, the chief executive of Brookfield Corporation, which has more than $1 trillion in assets under management. Bruce, this is our annual catch-up in London. And I always look forward to it. So thank you so much for coming on. How concerned are you about some kind of contagion from private credit into broader credit markets?
Look, I think we all have to, when all these things get brought up in the news, we have to step back from that and just think about it in a much more broad global perspective. Yeah. Private credit's very small, and software loans are even smaller. And in a global situation, the credit markets are very, very large, and this is not a systemic issue. There's only really two things that can bring the world down from a systemic basis, and that's bank balance sheets, and they're in excellent shape, and real estate loans, and housing in the world, and it's in excellent shape, and the consumer is still able to pay all its mortgages. So neither of those are systemic issues, and so I think we just have to step back and think about it into perspective. There's always, with revolutions or evolutions that are going on, it's never a straight line. And we just have to, there will be ebbs and flows on the way to what's going to be an incredibly productive era that's coming with the new technologies that are being developed. And it's been going on for 30 years. It may be going faster today, but this is just a continued evolution of what's been going on.
But Bruce, so why do you think the market seems on edge, right? You're right. So is it because they're worried about AI being systemic? Is it just there's too much money out there? They don't understand private credit? Like, why is everyone so on edge?
Firstly, I just think the world is always thinks it's the worst time at the moment. And when you've been through these before, they're always the worst. But I can tell you there's been 15 worse ones in even my career. And therefore, I think we just need to step back, put it in perspective. This is not that big of a deal.
So this is not a rerun of 08? Or in the run-up of a rerun?
It's definitely not of 08. Like, it's got nothing to do with 08. Now, will artificial intelligence affect some companies, and will some companies or loans to some companies be not pan out as they were expected, or multiples were paid too high for some businesses? Yes, that occurs in every cycle, and probably in 20 and 21 there were companies. We weren't doing it because we don't make software acquisitions or loans by and large, but there's always some of those things that come about. But this is not that big of a deal for the financial system. I think that's the most important thing, that the news gets wrapped up in small things that seem to be of the day.
People are fearful, right? And I can't point to what people are fearful about.
I think it's just change. People always are worried about change, and we're going through faster changes today than we've gone through before. And they keep change keeps getting more rapid all the time. And but I would go back and say, we've been building the backbone of the global economy for 40 years. And we do the exact same thing, except the type of things that we're building today are just different. Before, it was water systems and pipelines and toll roads, and then it was telecom towers, and now it's data centers and AI factories, and it's just the backbone evolves, and I think people just get unsettled by that.
I mean, do you think what happened at Blue Owl signals something broader?
No. Look. Again, just step back. It's a very small component, and therefore I don't. Firstly, just to be very specific, I don't run Blue Owl, and we don't really make loans in software. So this is not our business. Yeah. But if I step back just as a financial person, this is small relative to the global markets, and we shouldn't get too wrapped up in it.
So in this first clip, Bruce Flatt is very clearly saying that he does not believe that this is a repeat of 2008 or even a systemic issue. He's saying that the issues that are starting to pop up are very, very small, and he's also suggesting that they're related to businesses that simply overpaid for assets in 2021 and in 2022, when if you were investing during that time, it was absolute madness. The valuations across the market got so overheated. So if there were private equity firms buying companies at those extended high valuations, then yeah, they're probably sitting on losses right now. But that doesn't mean that the entire financial sector or private equity sector is going belly up. He's also saying that Blue Owl is a very, very small company, and one of their funds is even smaller, and they had that redemption issue because of, in my opinion, bad management, not bad loans. He's really just trying to say this is that the fears are not justified. And based on what I've seen so far, I would agree with him. I think that the fears are not justified, but today he says the market seems so on edge, so even these little things that start to pop up, they seem to explode and fears seem to run wild very quickly. And he's saying that this is because the rate of change in the global economy and with technology today is faster than ever before. And I think that this is putting people on edge because it's making the future more uncertain because we don't know how artificial intelligence is going to impact software, for example. And we don't know how it's going to impact really all business. So I think the clarity of the future and future cash flows for businesses is a little bit more uncertain than ever before because no one, I think at least, truly knows what artificial intelligence is going to look like and how it's going to impact businesses over the next 5 to 10 years. And therefore, if there are any signs of weakness, then it seems like investors go to just sell off that asset class today. It's sell first, ask questions later is the easiest way to put it. Yeah, I don't necessarily think that there's a large financial risk or we're going to experience 2008 again. I think that fear is definitely overblown. And I agree with Bruce Flatt. So let's continue on to the next clip, which I believe starts around 6 minutes and 30 seconds.
So you've been very acquisitive, and again, you've laid out the vision pretty clearly, which is, we build for the longer term and we invest in the economy of tomorrow. Is there anything that you're missing now that you want, where you think the economy will change, that you need a piece of?
You never know what's coming. Like we coined 3 Ds, or somebody coined, might have been us, not sure, many years ago, and that was deglobalization, decarbonization, digitalization. And even in the 7 years since we've been talking about those 3 Ds, the nuance, we've slightly changed each one. Like digitalization was really about building for cloud. And today it's building for AI factories. And decarbonization was building clean power. And today it's about building any possible power we can build because we need more power. And deglobalization was about building in the United States. And today it's about building in many different countries. And so I think there are nuances of change, and you never know what comes exactly tomorrow. But what I'd say is what's happening today is we're laying the fundamental backbone of the next layer of infrastructure. And artificial intelligence and the infrastructure to drive artificial intelligence is really just the toll road or the pipeline or the water system of yesterday. And it's of today. And that's really what's going on today, and it's being laid by countries, and we're helping some of them do it, and it's being laid by the big technology businesses because they have the resources to be able to do it.
So I want to stop the video here really quickly because Bruce Flatt is once again just highlighting how Brookfield invests. And they're now investing and building data centers and what they call AI factories, because they believe that this is going to be like the new utility of the future. Hyperscalers and governments need these massive data centers and AI factories to continue progressing artificial intelligence and developing the technology. And all Brookfield is doing is building those assets, leveraging their skills, and deploying them for the hyperscalers and for countries like Sweden. He views this as business as usual. It's just a new asset class that has popped up that the world needs, and it's going to act like a utility. That's what Brookfield does. It's a very simple business, and they operate and invest and own things that the world absolutely needs to operate and continue growing.
There's so much private capital going into building these AI data centers right now. What if demand doesn't live up to expectations?
Well, firstly, anything that we're doing is contracted to a country or a company. So that's their risk. Because when we start these developments, they're contracted. So that's the first point, and that's the big difference from people. People reckon back to when they were laying fiber in the .com era, and those were you laid fiber and you hoped a customer would come. Today, what we're doing is we're building AI data centers for countries and companies, and the countries are creditworthy?
Yep.
I hope so. And the companies are like countries. Yeah. These are enormous companies, and really they come to us because we have the resources to be able to help them facilitate the build out of power, connectivity, data center buildings, and and wire them inside. And that's really why they come to us and some others like us. But this is an enormous build out of the next layer of infrastructure in the world. And that's really all it is. And this time it's being led by the best of the world. Yep. And therefore the credit capacity is there. And in the private markets, there are no issues. In fact, the only issue is, can we build them? Like, we just can't build them fast enough because the demand is so large. Now, your question was, will it pay off?
Yeah, or is there too much capacity? I mean,
there is not too much capacity. We can't build enough. Yeah. But the question is, will it be profitable for them? Yeah. And I think it will be. And what we're seeing in our industrial businesses is being able to use artificial intelligence in very innovative ways to lead to productivity advances, I think, which will be probably the most productivity advances ever seen in a shortish period of time in the history of the world.
All right, so Bruce Flatt just said a lot in this clip as well. So just to discuss what he just said, is that he believes that these data centers will pay off over the long term because Brookfield is seeing massive productivity gains within their own business. And that's also why the demand for AI, at least in his view, is skyrocketing, and they cannot build enough data centers to satisfy all of the demand. So from Brookfield's perspective, it's not, are we building too much? Is there going to be overcapacity? He's saying it's quite literally, we can't build enough. We cannot get enough data centers deployed to meet all of the demand. The other main risk that the host asks about is the demand on the other side. And everyone tries to relate the AI infrastructure build out to what happened during the telecom bubble when people were laying fiber networks across the world, but there was no customers on the other end. They were kind of just hoping that the demand would be there on the other side. And that made the investment much more risky because you don't have a contractual agreement on the other side of your infrastructure build out to actually get the revenues and the cash flows to generate a return on all the money and capex you just spent. This is different because the hyperscalers and countries are leading this build out. So when Brookfield builds a data center, there's a contract in place already with a very profitable business or a literal country saying, hey, yes, we will buy your capacity immediately, and you're going to get returns pretty much guaranteed. So the risk is not nearly what it was. It's not similar to what happened in 2008. The demand is there. Brookfield is seeing the real productivity gains of artificial intelligence within their own business. That's why they have the conviction to continue investing hundreds of billions of dollars into this build out. And their customers are the best countries and companies in the world. So all around, their strategy, I think, is going to pay off. They have the operational expertise. They've been doing this for decades, and they really know how to deploy capital. So all around, I think Brookfield is going to continue growing and benefiting for decades to come. That is why it is the largest position in my portfolio. These are the reasons why I'm not necessarily concerned about what's happening with other private equity managers that are maybe lower quality, maybe invest in a little bit more speculative assets. And also why I'm not really worried about software impacting private equity or the Blue Owl news that came out, because I think that was just bad management. To put it simply, I think the sell-off is more fear and narrative driven. It's indiscriminate selling, and I don't really think it's justified for every private equity manager like Brookfield. Now, as I said earlier on, sorry, my cat Tuna wants to come hang out. But as I said earlier on in this video, I do believe that Brookfield Corporation and Brookfield Asset Management are looking undervalued today. A couple of DCFs that I did on the two stocks to show you why I think that they are undervalued today. So the first DCF that we're going to take a look at is Brookfield Asset Management. And they're projecting to grow their cash flows by 17% annually over the next 5 years. And I think a 25 price to free cash flow for this business is extremely fair. So if Brookfield Asset Management can achieve that 17% growth rate, then the stock could compound by roughly 16.6% annually. Its fair value would be $62 US, and its future stock price could be $86 per share. So based on Brookfield Asset Management's own outlook, and again, the business is currently seeing an acceleration to their growth, then it leads me to believe that this business is in fact undervalued today. And if the stock continues to fall, then I think that just presents a better and better buy. Now, if we take a look at Brookfield Corporation, they're projecting to grow their free cash flow by 25% annually over the next 5 years, but I use 20% to be a little bit more conservative. And I think a 20 price to free cash flow for this business is very fair. Now, if Brookfield Corporation can achieve their guidance, then the stock could compound by 22.5% annually over the next 5 years. Its fair value would be $75 per share, and its future stock price could be roughly $120, which is a 172% gain from where the stock is currently trading. So to put that simply, if Brookfield Corporation can achieve their 5-year guidance, then I think the stock is significantly undervalued today. And this is also partly why I think the sell-off in the business's share price doesn't really make sense, because the fundamentals are definitely continuing to grow, and the outlook for this business is incredibly strong. And with all that being said, that is going to wrap up today's video. That's all the news that has been coming out with the financial and private equity sector. That's my thoughts on it. That's why I think Brookfield Corporation and Brookfield Asset Management are the best buys in the space. That's why they're in my portfolio. And also, I quickly explained why I think the stocks are looking cheap. So if you enjoyed this video, then please remember to leave a like on it. And if you're not subscribed and you want to see more stock market related content like this, then please consider subscribing to my channel as well. As always, thank you so much for tuning in. I truly do appreciate it, and I hope to see you again in my next video.